So questions 8 and 9 are again a group of questions set together, and at the start of this question we're given a lot of information, but really it's just some extracts from the financial statements and a few margins and calculations that have been done for us already. So in terms of question 8 itself, first of all then, question 8 asks us which one of the following statements gives a valid and reasonable explanation for the reduction in the return on capital employed. So remember that return on capital employed is calculated by taking profit before interest and tax, sometimes referred to as operating profit, and dividing that by capital employed, where capital employed most commonly is really your equity and any interest-bearing borrowings. So if we go back to the information they've given us in the question, we can indeed see that return on capital employed has fallen slightly this year compared to last. But if we look at this first extract here, we can see that gross profit margin and profit before tax margin have actually both increased. Now what that suggests to me is that if we did have a full statement of profit or loss, what we would see is that either revenue has increased or expenses have decreased, but overall as a business profitability is on the increase rather than decline. So in terms of the two elements of my ROCE calculation, I'm not expecting the profit element to be any reason for a decline in this. So then if we carry on to the extract from the SFP that we've been given, and what we can see here is that we have a fairly substantial increase in our non-current assets. Now that could be because of purchases, because here I can see that the cash has decreased, so yes, we may well have gone and purchased some PPE, but actually here I can see that there's a reasonably large increase in the revaluation reserve. So I'm expecting that, at least in part, this increase in our PPE is as a result of some revaluations. A little bit further down, we do also have some additional borrowings this year, a total of 258 compared to 188, but most of these are short term and so wouldn't be included ordinarily in our capital employed part of the ROCE calculation. And the long-term borrowings are convertible bonds. So in actual fact, I suspect that this increase is actually more to do with actually providing for the interest that would be due and the convertible element, the liability element of that. So if I now go and look at my options as to why my ROCE may have reduced, so it says additional long-term borrowings have been taken out. Now we did see an increase in long-term borrowings, but we said that is most likely to be us accounting for the liability element that we actually needed to include from that convertible bond. So it doesn't appear as though there have actually been any additional borrowings. Increased finance costs from short-term borrowings. Well, remember here we were saying that actually what we include in the calculation is before any interest or tax, so increase in finance costs would not affect my ROCE calculation at all. Reduction in profit from operating margins. Well, again, when we looked at our other margins that have been calculated, both gross profit and profit before tax had increased between the years, so that doesn't appear to be a valid explanation, which hopefully means the last one is revaluation of property, plant and equipment. And yes, as part of our capital employed, we are going to include all of our equity accounts, including that revaluation reserve. And so that does mean we have a greater figure here, which would cause a decrease in our return on capital employed. So in this case, the correct answer, the most reasonable explanation would be the revaluation of property, plant and equipment.